Good evening, everyone. On behalf of the Council for Economic Education, I would like to welcome you all to a discussion on the virus, policy, and the economy, featuring Rebecca Patterson, Director of Investment Research at Bridgewater Associates, with Richard Falkenrath, Chief Administrative Officer at Bridgewater Associates. The event will be a discussion between our speakers, followed by about 20 minutes for Q&A. You can submit questions at any time during or after the discussion using the Q&A function in Zoom, which should be found in the bottom panel on your Zoom window. Without further ado, I would like to introduce Nan J. Morrison, President and CEO of the Council for Economic Education, for her opening remarks.
Thanks, Thomas. Good evening, everyone. Thanks so much for joining us, and thanks so much to Bridgewater Associates for lending us two of their luminaries, Rebecca Patterson and Richard Falkenrath, to discuss our topic today, the intersection of the virus, policy, and the economy. It's a very busy intersection. Adapting quickly to sudden catastrophic change is daunting for any of us, but it is a virtually insurmountable challenge for fragile communities, for families living paycheck to paycheck, for kids who are already struggling for a foothold, any foothold, in a better life. This crisis brought home to me, to our board and our staff, just how tenuous financial stability can be for many Americans and the toll that acute anxiety has on our children. It revealed fault lines throughout our society that cannot be vaccinated away. They will remain with us, a legacy of Corona, for better or worse. I say, let's make it better. Financial and economic education are not an entire answer, but these subjects are essential and still largely missing from our education, and they're really important in giving kids the survival tools they need. Addressing equity issues necessarily involves us in addressing access issues and disparities in knowledge and exposure. With this education, more of our kids will have the ability to assess difficulty and map out a path to a better destination. At CE, we emerge from this crisis with a reinvigorated mission, create more access to this knowledge and these skills. It's going to require continuing our digital transformation efforts to scale up our reach, incorporating equity into all of our programs and how we target them, and it's going to require developing reliable and constant political support as we advocate for a survey of the states to get a broader contingent of federal and state leadership involved in getting requirements passed. And some, it's going to require us to grow. We are on it, all of it. And with the ongoing involvement of this amazing community, we can get it done. But right now, let's do what we do best, generate more intellectual capital and take a hard look at where we are in order to get a better grasp on what we might be facing and where we're going. Our speakers tonight both hail from Bridgewater, as I noted, and I could come to a full stop right there. But let me do the honors of introducing my friend, Rebecca Patterson, who will lead the discussion and introduce her colleague, Richard Falkenrath. Rebecca is regularly ranked among our nation's most powerful women. Today, she is Director of Investment Research at Bridgewater Associates. She came to them as the highly successful CIO of Bessemer Investments. It was there, that's where I know her from. It was there in 2016 that she did the unthinkable. She prepared for all election eventualities, including a Trump win. As one journalist described it, on November 9th, when all the Asian stock markets posted heavy losses, Bessemer's assets were buffered from the fallout, removed largely from emerging markets and placed in US equities. She was prepared. Rebecca and I became acquainted around her enthusiasm for our mission, but for one of our programs in particular, Invest in Girls. It's a great program that introduces girls to the financial services industry through mentoring, hands-on exposure, and of course, education. What continues to amaze me about Rebecca is her openness to possibilities and her unique skill at charting a course through complexity with focused attention. She is the best of the best, and it's a gift to have her lead this discussion with her colleague, another formidable analyst and leader, Richard Falkenrath. Rebecca, I turn it over to you.
Thank you so much, Nan, and thank you everyone who's been able to join us tonight. I'd like to do the honors of introducing my colleague, Richard, before we jump into the discussion. So Richard Falkenrath is our Chief Administrative Officer at Bridgewater, where he's responsible for all of our operational risk management and administration. Now, Richard had an amazing career well before joining Bridgewater in 2014. He served as Deputy Commissioner for Counterterrorism for the New York City Police Department. He also served in the White House from 2000 to 2004 in different very senior security roles. And he, near and dear to everyone's hearts here, talking about education, he taught at Harvard. But most importantly for our discussion today, I think it's noteworthy that Richard began his professional life researching the role of infectious disease in international politics. And later, while he was in the White House under President George W. Bush, he was centrally involved in the US's response to the 2001 anthrax attacks, and then later, the US's response to the 2003 SARS outbreak. When COVID emerged at the end of last year and the beginning of this year, Richard was in a perfect position. He assembled a team of colleagues with technology, medical, scientific backgrounds, pulled them together to make sure that we had the best possible understanding of what was quickly evolving around the world. And with that monitoring, he was able to help us in the research department make the best understanding and the best interpretation we could of what was happening economically, and then translating that for markets. He advised our clients, and of course, he took care of all of us within the firm and our families through COVID, and continues to do so. So we're incredibly grateful, Richard, to you for all the work you've done and continue to do. Unfortunately, it's not over, but I can't think of anyone better to start our discussion tonight, which we're going to have in two parts. We're going to talk about what's happening with the virus itself, and hopefully end with some good news on the vaccine, and then pivot to how we're thinking about this backdrop when it comes to the economy and financial markets. But I'm going to first test out my technical skills and see if I can share screen. So I'm going to try to drive here for Richard for the next few minutes.
Thanks, Rebecca. Could you keep the slides down for just a second?
Happy to.
Thank you for the very kind introduction and invitation from the council. It's a real pleasure for me to come talk to you. I'm a true believer in the importance of education and economic education in particular. So we're in the middle of a global crisis, a global pandemic. Everyone now knows that. And I'm going to give you some data on it and talk about it. But I'd like to suggest a couple of different lenses on the same problem. Even before we turn to the economic analysis that Rebecca will share with you. I'll talk about some of the data that we're seeing with cases and hospitalization and how to interpret that data. But before getting in that, I want to put the pandemic in a sort of broader historical context, which is, for us, none of us have really been through anything like this before. The last major global pandemic that moved the world in the same way this one was 102 years ago. But the disease outbreaks are certainly not new, and in fact have been a permanent part of the human condition from the beginning of human history. And all organisms, all species, human beings among them, live in a sort of equilibrium with predators, including microbial predators, the viruses and the bacteria that are the kind of microorganisms that surround the macroorganisms like us. And so before I get into this particular thing, I just want to urge you to think about what's happening to the global economy and to our societies, to our families and ourselves. It really a very large global historical lens. As something that's been going on from time immemorial, which is microorganisms, viruses, bacteria, they will exist, they will evolve and mutate, and they will jump species. And when they jump species, there can often be a disequilibrium between the new species, in this case, the humans, and the microbe, in this case, the virus. And that's what happened here. And it was at a category, the category of this happening was entirely predictable. And you can go back, decades, and people have been forecasting the possibility of another pandemic. And the dice finally came up against us this year. And it started in Wuhan, in China. It became apparent in really December of 2019. It is probable that this virus jumped species before that. There's some interesting evidence emerging, but it didn't really take hold into the species until what happened in China in January of this year. And we spent as a world watching what was happening in China in January with trepidation and uncertainty about how this virus would spread and what impact it would have. And I would say it wasn't until February of this year that it became clear to public health experts and epidemiologists that the biological characteristics of this virus were not containable, that this would become a global pandemic that's affecting us, and that as it is right now today. And that is what we're living through. That we will come out of that as a society and as a species at the other end, in the coming years, maybe next year with the vaccine, maybe after that. But it is an extremely disruptive phase that we're in. That's both costly in terms of health and mortality, and in terms of the fear that it induces in everyone, the psychological effect, and in terms of the impact on economies and society and inequality and so many other things that you care about. So that's really what I wanted to start with before we start looking at some data. And I'm now going to take you through some data about the disease to show you what's been happening. So Rebecca, if you could, I hate to make you the one driving the slides, if you could go to the first slide, I want to show you. This first slide, it shows you daily new cases in a couple different countries. And the way, this isn't everywhere. So if we only picked a few countries, European countries, the United States and South Korea, it would be different if we showed China, of course. I want to, since you're all you're learning about economics, how to interpret data, I want to make sure you understand this data is normalized. And because data is very spiky and difficult to interpret, the best way to think about cases for the disease is cases per 100,000 on a 7-day rolling average. And so what that does is that deals with some of the differences that we'll see. And so what you see is really rather stable growth in lots of different places that grew fast in March and April, long stable phase, slight uptick in the summer in the United States, stability, and then explosive growth in countries that by then had already survived 6 to 8 months of the virus. Now, the first thing I want to point out about this, when you interpret a graph like this, is it's not a perfectly consistent read on the data over time. And the reason for that is these are cases that require a positive clinical diagnosis and a test. And so early in the disease, we had limitations in our testing, and true cases were far higher than were actually indicated. But nonetheless, the read that is really good is you had explosive growth in a number of different countries. I'm showing 3 here. Now, question, what drove that sudden growth? And if I was in a classroom together, if I was back to being a professor, a job which I truly loved, by the way, I would be quizzing people on their theories and doing this sort of Socratically. So I don't get to do that in this format. But what drove the growth is not a change in the virus. There are mutations happening, but they're not significant for the overall pattern that we're seeing. And it wasn't a new medicine. Like, we have no pharmaceutical intervention to this yet, although vaccines began to be administered this month. What drove this is changes in human behavior. And when human behavior changed in such a way that the virus could quickly spread again and indeed resume exponential growth, it did. And that is just a byproduct of the biologic properties of the virus. And of course, since you're learning about math, about exponential growth and how things grow fast once they're truly exponential and can explode. And also the lag times between a spreading event and knowing about it. So one way to look at epidemiologic data on this is it's kind of like looking at the stars. And when you look at the stars, you're seeing light that's hitting your eyeballs or the telescope lens. That light actually occurred sometime in the past when it began flying through space and reaching you. And epidemiology is like that. So we're seeing a case on today. That case is in fact a result of something which happened 2 weeks ago. So very important point on understanding. So where are we right now? You've seen other countries have gotten this under control. Here in the United States, we do not have this under control yet. It is growing very fast. I'm going to talk about that now on the next slide, where you can see some of the regional variations. So Rebecca, could you go to the next slide? So this shows the regional variations on this. Yeah, basically double clicking into the slide that I was just showing, but only for the United States, breaking it into 4 regions: East, West, South, Northeast, South, the West, and the Midwest. What you see is a big sharp growth in the Northeast, where Rebecca and I live, at the beginning, which was brought under control in May. And then the virus sort of hung around and it took off in the Sun Belt over the summer. And then we sort of got it under control, but never really. There was still lots and lots of virus moving around. And then when people got lazy and stopped social distancing and started going indoors more often, where the disease is far more likely to spread, it exploded. It exploded first in the Northwest, in the upper Midwest, but now it's sort of everywhere. And so what we no longer have is a regionally differentiated outbreak, which we had in the spring, and then we had midsummer. Now we have a pervasive outbreak that's happening everywhere. So it's in general community spread. Means there's far too many cases for public health authorities to ever track. It's just spreading. And this is going to keep going until one of two things happen, meaning the upward trend will keep going until one of two things happen. First, either people will change behavior and we'll have another crackdown, another lockdown, which is happening all over. Rebecca's going to talk to you about some of the effects of that in just a minute, which can, in a very crude way, can slow the spread of cases. We just know that will work. It's if you lock down a society or a city or a state, 2 weeks later, cases will start to fall dramatically. And then the second thing is we can have an immune response. And the immune response can be either naturally acquired, like you recover from the disease, enough people get it, you have herd immunity, or it can be artificially acquired. And that is the vaccine, which is the really remarkable thing I'm going to come to in a minute. My last slide before I turn it back over to Rebecca is cases. Not cases, but deaths and hospitalizations. So cases are filtered through our testing methodologies and they're biased. So they're not perfect. Hospitalizations are actually really good quality data. And deaths, unfortunately, deaths from COVID are high quality data. In both cases in the United States, we are now in excess of the peak from the spring. So we have more hospitalizations happening as a result of COVID nationwide than we did at the beginning, and we have more deaths than we did at the beginning. And those trends will continue rising in rough proportion to total cases until one of the two things happens from before. So big, long introduction, lots of data, and turn it back to you, Rebecca.
There we go. Get myself off mute. Thank you, Richard. And when we get to the Q&A part of our conversation tonight, I think we've just touched the tip of the iceberg in terms of Richard's knowledge and to get into things like the vaccines and some different experiences across countries to the degree that's interesting for some of the folks listening to our call tonight. I would definitely encourage you to ask Richard about those things. Let me, though, pivot us for a few minutes to what this means for the economy. If I can, there we go. Okay, so there's nothing on this slide at all about the virus or the vaccine, and yet everything on this slide I think is incredibly important to understand both what the economy is doing and likely to keep doing and how the markets are reacting. This is probably the most important thing I could talk to you about tonight outside of actually the virus and vaccine. So I want to take a step back just for a minute and talk about the policy backdrop, because what COVID did is accelerate what we see as a paradigm shift in how the economy and financial markets work. The shift was already happening, but the pandemic accelerated it. And so what I mean by that is when most of us on this call today were growing up, we had basically central banks affecting the economy through interest rates, right? Just raising or lowering Fed funds in the case of the US to affect the economy. But when interest rates around the developed world anyway got closer and closer to zero, as we got to the 2008-2009 crisis, that tool wasn't effective anymore. And so central banks increasingly adopted quantitative easing, QE, or asset purchases. And they used that to get liquidity into the financial system. And that did help reflate the economy, although more through financial assets than the real economy. Now, when we got to the pandemic, the hit to the global economy was so big that monetary policy alone was not going to be sufficient to dig us out of that hole. And so it pushed us into what we call MP3, monetary policy 3, which is really, even though the Fed and central banks are still independent, it's a much closer coordination between monetary and fiscal policy, where the Fed, in the case of the United States, is facilitating the deficits that are being built by the US government. So the Fed is printing money, buying assets to keep our interest rate costs low, and allowing the government to pump money into the real economy. So that's where we are today. And I think, excuse me, been fine all day. I think this is a really important backdrop for all of us to have in mind, because it really is influencing everything that's happening. Now, the chart on the right is also, in my mind, incredibly important. although it's really simple. What we're looking at here, the blue line is just the US short-term interest rate, the Fed funds rate. The gray bars are US recessions. The red dotted lines are what the market expected interest rates to do. So what you can see is when we've had slowdowns in the US or recessions, interest rates would come down, of course, but then afterwards, the market would expect a fairly quick rebound. As the economy recovered, as inflation expectations recovered, the Fed would remove that accommodation and normalize interest rates. Now, if you look at the bottom right of this chart, what you see is something different. Instead of those red dotted lines going up, they just kind of go straight across. What the market is pricing in today is part of this MP3 backdrop. Basically, the market is discounting that the Federal Reserve will not raise interest rates at least until 2023, perhaps longer. I know at least one large investment bank putting out its year ahead outlook this week is saying 2025 for the first Fed funds increase. And part of the reason that the market is so sure this time is going to be different is because the Federal Reserve changed its reaction function. This summer, it came out and said, we're no longer going to start raising rates when we see inflation getting towards 2%, which is their target. Instead, we're going to encourage inflation, not only 2, but above 2% to make sure inflation averages about 2% over the course of a cycle. So it's the credibility of the Fed's new inflation targeting mechanism, plus this idea that the Fed will have to keep rates low to facilitate these very large budget deficits. That's influencing this expectation that low interest rates will stay for a long time. And again, I'm focusing on the US here, but I don't mean to be US centric. We're seeing this same similar situation happening across the developed world and even in some emerging markets. Now, let me get back to the virus and the vaccine, kind of picking up where Richard left off. The chart on the left here is showing something I think pretty intuitive. When the virus picks up, and we have lockdowns and people can't go outside and get haircuts and go to the dentist and go out to eat, there's less what we call retail mobility. So that would be kind of the bottom left there when everyone's shut in their homes. And you can see the relationship between that and GDP. So actual economic activity, it comes down as mobility is down. And so it's not surprising that as people look forward and say, okay, we know we might have lockdowns in the next month or two as we go through this next wave of the virus, but the vaccine's around the corner. People are starting to get shots. The vaccine is starting to be distributed. And therefore, we can assume we'll have greater mobility, and that will lead to greater overall activity. And what we're seeing today in the financial markets is that expectation being reflected. Instead of financial markets focusing on the very short term, second wave of the virus, possible hit to economic activity from these lockdowns, it's saying, yes, we get that, but that's temporary. And the vaccine is hopefully a permanent solution. And so the markets are forward looking and they're saying, we're going to focus on that. The vaccine is coming. We're going to have the mobility. And so they're looking at sectors of the economy, things like the chart on the right, oil, hotels, airlines, areas that were heavily hit by the virus. And those stocks are working in a positive way, with the odds of vaccine rollout. So as the odds of a vaccine rollout have increased, we're starting to see things get approved, starting to see governments saying we're ready to go. You're seeing those stocks doing better. And the stocks that benefited from while all of us were locked in our homes, working from home, technology, for example, semiconductors, making the chips that go into our technology, those stocks are having a negative correlation. So what you're seeing is a rotation. People rotating out of those defensive, quote unquote, stay at home stocks into these cyclically sensitive stocks that will benefit from greater mobility. Now, it's really interesting looking at this to then take a step back and think about that slide I just showed you with MP3 and those low interest rates. Because if you simply looked at history, and we all study history as part of understanding the world today and going forward, if you simply looked at history, you would expect this rotation to be pretty stark, pretty sustained. But the fact that interest rates are going to be low for longer changes the dynamic in some important ways. So the first, and I think probably the most important thing it does, is it pushes all investors out the risk curve. And what I mean by that is if you took a typical portfolio that was 70% equity risk and 30% bond risk, well, that 30% bond risk, now you're getting less and less return from it. In fact, you might be looking at a negative return in the years ahead, and you're not getting as much diversification from that part of your portfolio because yields can't fall as much when equities fall as they did often in the past. And so investors, to get the return they're looking for, are being pushed out to own more equities to try to generate that total return they need. And so that asset allocation is going into all stocks, not just the vaccine recovery stocks. And so the whole equity market is getting a lift from this. So I think that's an important dynamic to keep in mind. One possible consideration here is what kind of stocks do people want? Okay, fine. I need to get my, call it 8% return or 12% return. Wouldn't that be nice this year? Yes. And so I might have to take more risk to get there, but I don't want to have that much equity risk in my portfolio. I want some things that have bond-like characteristics. And so investors are still looking around in the equity market and saying, well, maybe there's stocks with stable cash flows that will have less sensitivity to changes in economic conditions. Maybe there are companies that have stronger balance sheets, more free cash flow that will make them less sensitive to economic conditions. And guess what? Some of those stocks are the technology stocks that are being rotated out of right now. So I guess my bottom line is that when you think about the recovery from this virus as it plays out around the world, the excitement around a vaccine, that rotation is going to be different in at least two critical ways. One, it's likely to push people slowly out of bonds, more into cyclical assets, including equities, both public and private. And secondly, while there should be a rotation, and we're already seeing it starting, it is going to be a little different this time potentially, because investors are still looking for any asset that can give them some diversification and safety. And some of that, interestingly, can still be found in the stock market. Now, this is all talking about the short term. And of course, within this page, there's a lot of differentiation between countries. You know, the US is getting the vaccine rollout going quite quickly. Other countries might see that happening more slowly. Some countries are going to have more sectors that are sensitive to the vaccine. Those equity markets might rally faster. Others more slowly because they're going to have equity sectors that are tied to those things. So there's going to be a lot of differentiation between countries, partly depending on their vaccine rollout and the type of economy and type of equity market they have. The other big difference, going back to my first slide, will be the policy response. You know, where do we see relatively more fiscal stimulus or monetary stimulus? That will also affect how quickly the economies can recover. Obviously, China has been in the lead this year. China's economy is already back above its pre-COVID levels of activity. It's the first economy to totally recover and then continue to climb ahead. And that was partly because they had a very stringent policy locking down when the virus hit. They did have a decent amount of stimulus to help them recover. But then the makeup of their economy, they're actually making a lot of goods that the rest of the world has needed during this time. So all those things have benefited them. Let me go to the last slide, because again, what we're talking about here is fairly near term. And even though the vaccine, fortunately, is starting to change the picture a lot in a very positive way, there's another piece of this puzzle that's not going to change with the vaccine. And that is the need for stimulus to continue for a long time. So one could assume as we get the vaccine, as we have economies reopening, we have equity markets recovering, that policymakers could take their foot off the gas a little bit and stimulate less. And that would make sense, except you have this structural underpinning that I'm showing you on this slide. So on the left of this page, and again, I apologize for being so US-centric with my visuals tonight, because we see these same dynamics happening in many, many economies today. On the left, what you're seeing here is debt, or IOUs. And again, in this case, it's the US. And we've just added up all the private sector and public sector IOUs out there. And that little red dot on the top right of that chart, that was our expectation for where those debt levels were going before we had the pandemic. Today, they'd be much higher. Now, this might overstate the problem a teeny bit in that some of these debts do have cash flows against them, things like Social Security. There is money going to help pay for these things. But what this tells you is that central banks do still need to keep interest rates low to manage the interest rate costs of all these debts. And governments need to stimulate to generate growth to help pay for these debts. And the best thing we could see is fiscal stimulus that has true productivity enhancing gains, things like infrastructure, research and development, and of course, Nan, education that will pay dividends, and that can help us stabilize these debt levels. But that's a situation that's going to be with us even after the vaccine hopefully eradicates or at least gets the pandemic under control. And so for that reason, we think MP3, this combination of fiscal and monetary coordination with low rates and bigger budget deficits, will probably need to stay. The other more structural reason that I think this MP3 situation may need to stay is the chart on the right, which is our own estimate of global populism. What we've done here is we've taken major elections over the years where an anti-establishment or populist candidate was elected in a major economy. And we tried to index that, and you can see that we've come down recently with President-elect Biden. We've taken down that because we don't consider him an anti-establishment candidate, but you still see levels of populism, and this is globally, at levels that are basically in line with where we were in the 1920s and 30s. So it's still really high. And what that means is that governments will need to continue addressing this part of the population that feels like it's been left behind by the system. And that also suggests, in our view, a need for lower interest rates and more fiscal spending to try to help these folks get jobs, get incomes, and reduce some of those pressures. So if I had to pull all this together, I think that there's the very short-term reality, which is, as Richard said, the pandemic's getting worse. But the medium-term optimism around this vaccine rollout, that's what the markets are focusing on. And they're focusing especially on the economies that are going to benefit from that the most. We look at that and we say, okay, that's good. But at the same time, we have to understand which economies are more or less likely to keep rates low, to keep fiscal stimulus high, to address not only these short-term hurdles, but some of these longer-term structural challenges. And so that's kind of some of the big things we're looking at in terms of the world with the vaccine right now and the virus. But Nan, maybe I'll pause there and we can open up for questions and see where folks on this call would like to take it.
That would be great, Rebecca. Actually, we had a first, Thomas, do you just want to review for people the process for Q&A?
Absolutely. Just as a reminder, we're using the Zoom Q&A function. So if you look on the bottom panel of your Zoom window, you should find it there, and you can put your questions in there and we will route it through to our speakers. Thank you so much.
Yeah, and Richard, there was a question from you from our board chair about how long it will take the vaccine to bend the curve that we've seen.
It's a great question. Let's set that question up by saying when we look at vaccines, there's two things you're looking for: a direct protective benefit and an indirect protective benefit. So the direct one is the person who gets it, how well protected are they against the disease? That happens relatively quickly, we think. So with the messenger RNA vaccine that Moderna and Pfizer are doing, we think that'll start having effect, certainly maybe within 14 days of the first shot, and then definitely another 7 to 10 days after the second shot. Very strong protective efficacy. The indirect effect is going to be a function of two things. First is the efficacy of the virus at stopping spread, meaning protecting a person from getting sick, but then also reducing the amount of virus that they're shedding, a number which is not yet known. And second, the uptake in the virus and how many people of the vaccine and how many people ultimately get it. And so the answer to the question, Barry, is we're not sure, because it depends on two inputs that we don't know yet. Optimistically, I'd say most projections are trending towards sort of middle of next year for the United States, where everything is looking pretty good right now at the outer edge of kind of anyone's projections of vaccine efficacy. But if there was a rapid drop off in the willingness of people, the general public, to take it, then we would not see the same bending of the curve. And what is most likely in the case of a respiratory virus like this is not eradication. There's only been one disease that's ever been fully eradicated by human intervention, that's smallpox. And smallpox has no animal reservoir. What is most likely is containment and equilibrium. And since the duration of the immune effect, both naturally and from the vaccine, doesn't seem to be permanent, it seems to be like 6 to 12 months. In all likelihood, we're going to have an annual vaccination program for COVID, not unlike what we have with influenza, and we will be managing it for the rest of our lives as just another seasonal infection.
Thanks. Thank you. And I'd like to pop over to Rebecca now. So if the markets are wrong and rates surprise to the upside by the second half next year, what sectors would you emphasize and de-emphasize?
So I think it's a great question because you can imagine a world where we have really easy monetary policy globally. We have a decent amount of fiscal policy, although the degree of that probably will slow down next year, but we could get more. We're talking about more in the US right now, possibly before year end, and maybe even more in the coming year under the new administration. So you have easy monetary and fiscal, and then you get the vaccine on top of that, which almost acts like a stimulus. And you could have a real boom in growth in the spring, summer months, potentially. So if you have that uptick in growth and possibly inflation alongside it, then how does the Fed react to that? How much will they let bond yields rise? Right now, if you look across consensus estimates, it has the 10-year yield, which right now is around 90 basis points. Most investment firms are looking for the 10-year yield to get somewhere around 1.3, 1.5% at the end of next year, which would suggest a steepening of the US yield curve, so long-term yields going up, but also by a lot less than we've had historically. I think this is going to be a real test of the Federal Reserve. How much would they let yields rise even in this situation, given that they still want to make sure inflation gets back to and above 2%? I think they'd probably be watching inflation expectations very carefully. So the market's interpretation of inflation going forward, which right now shows inflation basically flat for the next 5 to 10 years. They'll probably also be looking for pass-through from higher yields to parts of the economy, particularly the housing market, but also other signs that the real economy is being negatively affected by higher interest rates in some way. If they were to see any of those things taking place, I think personally that there would be a good chance that the Federal Reserve could react and adopt something that we're seeing in more and more economies around the world, which is a different form of what I would call yield curve control, or some people are calling it quantitative easing control. And what I mean by that is just adjusting the amount of asset purchases they're making to ensure that the yields don't rise further than necessary to make sure they get to the targets they're trying to reach. If the Fed somehow lets yields keep going up, if that happened unexpectedly, I think that could be a negative shock for equity markets. I don't think the Fed would let that happen. If we had such strong growth that we get some rise in yields, I think the sectors that are likely to benefit from that, to get to your question, all else equal, certainly good for banks because their net interest margins would be supported by that, although a strong economy would also be good for that sector. So that's one I would definitely call out.
Great. And this is continuing a discussion about the inflation. Please discuss the possibility that, well, I think we covered this might change in the next 12 to 24 months. What probability would you put on that, and what factors would enable it? So a little bit of a dig down on the prior question.
Sure. So inflation, agreed. So over the last several years, despite interest rates at zero, despite on and off stimulus, we haven't been able to see inflation take off. And we really think at this point in time, easy money is not enough. You have to get the fiscal stimulus as well as the monetary stimulus in order to generate inflation. You have to get the money to the real economy for people to spend it, for companies to spend it to generate inflation. And fiscal policy is hard because it's politicians at the end of the day. And so you can't predict it with the same ease you predict monetary policy, where they have clear targets and you can measure how that's tracking. So we have to see what kind of fiscal stimulus we get in the year ahead, but it seems likely we're going to get more out of the US. We know in Europe, the European Recovery Fund is coming online at the beginning of the year. That's going to be major stimulus. Japan just passed a new stimulus package. So it does seem, at least in some economies, that we are getting that MP3 backdrop that could actually create some inflation. I think there's another piece of the inflation puzzle, which is on the supply side. And I think it's been fascinating if you look at the Federal Reserve's Beige Book reports recently, or just anecdotally in the press. I was reading in one of the papers yesterday that there's a shortage of Christmas trees tied to COVID. Everyone's at home, everyone wants a tree, and so they don't have as many. So you're seeing huge price inflation in Christmas trees. You're seeing a backup of containers in Los Angeles ports again because workers are sick. They can't get people to unload all the containers quickly enough. And so you're seeing inflation come through the supply side as well. I don't know if we're going to get a real change in inflation. Some of it is dependent on structural factors, demographics, which weighs against inflation. Globalization, I think, is a question mark with the new administration. But I do think the scope for inflation over the next 12 to 24 months is greater today than it has been in a very long time. And so what we're talking to our clients about is we're not sure if it's going to come and how bad and how quickly, but we do think it makes sense to think about how you protect yourself against it, whether that's something like inflation-linked bonds or gold or other inflation-sensitive assets in a portfolio.
You were talking about labor not being available, and it got me thinking a little bit more about one of the last points that Richard made, which was, are people going to actually get vaccinated? And this is a really interesting topic because it's not about the science, it's about the mentality. And so Richard, from your past experience and policy experience, how are you seeing this these days? We hear Dr. Fauci speaking about this all the time, but what are some of the factors that are influencing different segments of the population and thinking about whether they should be vaccinated or not?
Well, one thing that influences for sure is people who feel that they're at risk themselves. And so that they're fearful that they're going to get it. So vulnerable populations and people in exposed industries, healthcare workers, first responders, they're going to take it very quickly. There's two categories that we're particularly worried about for everyone else. One is the ones who are sort of indifferent. They don't think they're at risk. And they're basically kind of free riders on everyone else taking it. And while the odds of a healthy 25-year-old actually dying from the disease are very low, the risk that they're posing, the sort of negative externality on the rest of the world, is that they can be carriers and they can spread it to others. So that category is really very problematic. And there'll be education efforts by public health officials to counteract that over time, but we're worried about that. The second one are the ones who are just sort of objectors to a vaccine, or that believe have heard stories about adverse effects in a certain population. And so you see this in the anti-vaxxing movement, where people are concerned about a connection to autism. In that case, there will be versions of that in this case, without a doubt. The vaccines that we're going to be getting in the United States are completely novel. These are advanced, sophisticated genetic vaccines that manipulate the body's own cellular mechanisms to trigger an immune response in ways that sound like science fiction when you explain it. And in the course of that, when you administer a drug like this, a powerful drug to tens, hundreds, millions, thousands of people, there are going to be some adverse consequences, and probably some really visible ones that will get a lot of attention. And those are going to be hard for people to interpret. It's hard to deal with a really visible, low probability event. People often think, oh my God, that's very likely that that'll happen. But that's going to be part of it, is there will be a hardcore that just under no circumstance are going to take it for their own risk calculation. The biggest hope is to swing the ones who are basically are not personally much at risk, but don't have a huge moral or intellectual objection. They're just sort of not getting around to doing it. And I think you'll see education efforts to counteract that.
You're on mute, Nan. There you go.
A long way on my screen with my cursor from the questions to the mic. And we had a very long question. So with GDP growth falling, the paradox is that stocks are rising every day, it seems. And a key explanation is that that is due to falling nominal rates, basically zero. So would rising GDP growth, which would lead to higher long-term nominal rates, lead to falling stock prices? We start seeing growth as the stock market go down. And how do you look at these kind of paradoxes?
Sure. So GDP going down and stocks going up, I think that's a good one to address because it gets so much media attention. And I think a lot of people scratch their heads and say, shouldn't there be a relationship between the economy and financial assets? And I think the thing that links them together and explains the difference is the policy response that we've gotten. The fiscal stimulus that we got earlier in the year, $3 trillion worth of fiscal stimulus, was more than enough to cover the gaps, if you will, that occurred in individual household incomes And we actually saw the savings rate in the United States skyrocket because we more than filled that gap. And the savings rate today in the United States is still almost double what it was pre-COVID. And so we've given some, sadly, not all consumers equally, but we've given consumers on average quite a buffer. And so the economy is down because we're not spending as much, but the financial well-being of the aggregate, again, we want to be careful with the aggregate because there's a lot of difference under the hood, if you will, if you look at quintiles of the population, but the aggregate is doing okay. And so that's the fiscal stimulus. The monetary stimulus, obviously pushing down real interest rates, has been incredibly stimulative, and we've had trillions of dollars of liquidity going into the system. And so companies are looking at low discount rates, a lot of liquidity, and investors who are able to invest saying, you know, where else am I going to put my money? I can't get my return from bonds anymore. So I'm being forced out the risk curve into equities. And by the way, I think all this stimulation is going to lead to better growth in the future. So they're not looking at the next 6 months or 12 months, they're looking at the next 20 years and what this means for that cash flow. So I think that helps explain the difference between the economy where we are today and how people are looking forward with the market, both because of the past stimulus we've had and the future with the vaccine and further stimulus. In terms of if the yield starts going up along with the recovery and growth, does that hurt stocks? Again, I'd go back to why is the yield going up? What's driving that? And how far does the Federal Reserve let it go up? And I think we have a Fed meeting coming up actually in the coming days. And I would expect we're going to get more guidance from Chairman Powell in terms of what their thinking is. They know the economy is likely to recover next year. So how are they processing that? How are they going to try to guide the market's thinking into what they will allow in rates or not, and what they will do with their asset purchase program? And I think this week will be important to shape that sentiment. If yields are rising because growth is that strong, I don't think that necessarily means that equities can't go up, but again, it does shift the sorts of equities that go up. And so I think that rotation we talked about earlier is likely to continue. But given the Fed's new mandate on inflation, I have to think that they're not going to let yields continue to rise, especially if they see it starting to feed through into inflation expectations or the real economy through housing, et cetera.
So I know you said this was a mostly domestic talk, but this is a little broader question. What's your view of the dollar looking forward?
Oh, I'm
international.
Yeah, very, very happy to go international. And I know Richard is as well as looking at the pandemic, not just in the United States, but around the world. And it's been fascinating for us this year to think about different countries, how they're processing the virus, how they're rolling out the vaccine. There's a lot of differentiation, both economically and with the pandemic. In the case of the dollar, the one thing that helped the dollar in recent years was that you had relatively attractive yields in the United States vis-a-vis other countries. And so foreign investors would want to put their capital here to pick up that higher yield relative to what they could get at home. That was a pretty important capital flow supporting the dollar. And with the Fed now taking rates down close to zero and suggesting they're going to keep yields low for quite some time, that level of attractiveness has been diminished substantially. At the same time, the valuation of the dollar was not particularly cheap going into COVID. So yes, the dollar has weakened this year, but from a relatively high level. And we think both from a valuation point of view and from this flow point of view, there probably is scope for further dollar downside as we look ahead. One of the most interesting questions though, because everyone wants a weaker currency right now, right? Everyone's looking for ways to boost growth. Everyone's looking for ways to fight deflationary risks. And a weaker currency is a way to generate inflation. So you had the European Central Bank at their last policy meeting just a few days ago, actually saying we're a little concerned that the euro is too strong. We've had a number of countries across Asia, from Thailand to Taiwan and others, starting to intervene in their currency markets because the currencies are getting so strong, they're threatening their export-led recoveries. And so if everyone is trying to get a weaker currency, then what? Right? So what is the storehold of wealth that doesn't get depreciated? And that takes us back to things like gold. And maybe for some investors out there, Bitcoin. People are looking for things that can't be depreciated by policymakers. And even though gold has come off its highs in recent months, we think there's probably scope there for it to continue to appreciate, especially given what could happen with the Fed trying to keep yields low, what that means for the dollar, but also central banks around the world.
I wanted to pop back to Richard. We have an interesting question from a friend of mine, Ranji Thomas, who worked for me once. So this is kind of an interesting policy question. Should the government have allowed people to voluntarily take vaccines starting in July once the safety and immune response were largely established? Call it an expanded trial to get more real-time data points, you know, for people that are willing to take that risk, because you talked about the fact that so many people could be risk averse. There could be people that have adverse reactions, but it's kind of an interesting thought. Could people have voluntarily gone into this, and would this have been different in the US versus another country? I mean, we were living in very unusual times.
It's a really interesting question. And I think historians and others will be debating about the decisions made by policymakers in the last 10 months for decades. One thing I would just occur, I approach these questions with a lot of humility. Like the question you're asking is about the standard for pharmaceutical approval for widespread use. That's a really complicated question of which I have only glancing expertise. And these are really hard questions, as you all know. I would say I'm not sure I agree with the premise that safety was established in July. And I'm also not sure I agree with the premise that immune response was established in July in a representative sample of the population. And so it is true that the production of antibodies in a controlled setting was established for these and other vaccines in July. That's correct. But we did not know what we know in late November. We did not know it in July. We did not know about the 94% of efficacy that we're seeing for the 2 mRNA vaccines and the really promising safety event. And those projections, those outcomes, those safety and efficacy are on the outer edges of the cones of probability that anyone would have seen. And so that's a wonderful development for science, particularly if it's sustained, and I'm hopeful it will. But it is really pushing our expectations. Furthermore, the speed with which this is happening and the parallel nature of the regulatory approval. So we've not gone sequentially phase 1, phase 2, phase 3 trials. We've gone in parallel for all of them, is completely unprecedented for vaccines. And the next fastest vaccine ever brought to market took 5 years after the one we just now done in 10 months. And there's others coming, which is an amazing, amazing outcome. Again, pushing the boundaries of what could realistically be expected of this. So I'm not sure I know that the right answer to your very profound question that necessarily, but I think given the totality of the circumstances, the policymakers and the regulators for the vaccines did a pretty good job. And I actually think I don't want to get political here, but of the many things you could criticize the US government for in the last year of the response, what's called Operation Warp Speed, or the vaccine program, I think will be looked at favorably in history as something that had a pretty remarkable outcome and has the potential to have second and third order effects on human health far beyond COVID. Sort of like the space race and the Cold War gave us the interstate highway system and Velcro and Tang. The breakthrough in genetic medicine that was propelled by this pandemic and the investment in it will have second and order effects on our ability to manage other diseases in future that wouldn't have otherwise happened.
Yeah, thank you so much for that. It is interesting to see what's next as a result of this. I hope it's something better than Tang. So Rebecca, you went global. I'd like to take us right back down to good old New York City. So Rebecca actually shared with me just before we got started today that over the holiday time period, she's not really resting because she's moving to a place they bought in New York City, which made me feel great because it says people are still buying places to live in New York. So, you know, looking around your neighborhood, I know I look around my neighborhood, stores are closed, stores in my building aren't paying us rent. What do you see as the prospects for our beloved city?
Oh boy, it's a great question. And I don't have a great answer, to be honest. It's something we're wrestling with and thinking about a lot. I want to say New York will always bounce back because there's going to be certain industries that benefit from having a critical mass here. And you have great schools, so you will attract students. That means you have a great labor force, which attracts companies. So I think that all those effects that kind of create a positive flywheel will be positive for the city. But it is interesting in the short run, thinking about what this pandemic has done to the economy in terms of state and local governments. And you're seeing the debate on Capitol Hill right now, whether there should be aid given to state and local governments. Some questions about, fine, give it to them, but not to the pensions if they didn't do a good job running them, some in general. But I do have a concern that if the budget holes are too big, and remember, states have to balance their budget, so they have to make cuts. And if those cuts mean that you have less services and higher taxes, and that leads to people leaving the state to lower tax states, that the problem might get worse before it gets better. And so we have to, I think, in a way, cross our fingers that there is enough help given to states and cities, whether directly or through other means, through fiscal stimulus, to help them cover that gap. And so these places are still really attractive, and they can get the young people, they can get the labor force to attract the companies, so we can get that positive flywheel going quickly. So over the medium long term, I'm still very optimistic. In the short term, I think a lot of it is going to depend on whether these states and cities can do what's needed to get through this pandemic period without having to raise taxes a lot and cut services a lot, which could affect their attractiveness to would-be workers and families.
I'm sorry that I ended with a somewhat down moment there, but I do agree that in the long term, there's goodness around for New York City, and certainly for what this will all mean for science in the future as well. So I want to just, again, thank you both for joining us this evening. We really appreciate it. Also fielding some deep and tough questions. And to everybody, all of our friends and donors and supporters who are listening tonight, thank you so much for spending some time with us. I know everybody's just kind of getting ready to be done for the year. But before you're done, I hope you will take a moment to support us. We're in the midst of our winter appeal, and we want everybody to have access to the education that allows them to turn into the next Richard and Rebecca. So thanks for your support. Thanks for joining us this evening. And thanks again to our wonderful, wonderful speakers for their time, which is so very valuable.
Well, thank you for everything you do, Nan. CE is an amazing organization. Happy to help tonight.
Thanks.